A landlord does not simply collect rent and keep all of it. Rental property income has layers. Money comes in through rent and sometimes fees, but money also leaves through mortgage payments, repairs, insurance, taxes, management, vacancies, and legal costs. A rental can look profitable from the outside while the owner is only keeping a small portion after expenses. The most obvious income is monthly rent. If a tenant pays $2,000 a month, the property produces $24,000 a year before expenses. That number is called gross rental income. It is useful, but it can be misleading. A landlord cannot judge profit by rent alone, because the property has costs even when the tenant pays on time. The mortgage is often the largest cost. If the landlord borrowed money to buy the property, part of the rent may go straight to the lender. The payment may include principal and interest. Principal slowly reduces the loan balance. Interest is the cost of borrowing. A property can have positive long-term value even when monthly cash flow is tight because the loan is being paid down. Operating expenses come next. Property tax, landlord insurance, repairs, utilities paid by the owner, pest control, landscaping, accounting, licensing, and association fees can all reduce profit. A new landlord may underestimate these because they do not happen evenly. One quiet month may be followed by a broken water heater, roof leak, or air conditioning repair. Vacancy is another cost. If a unit sits empty for 1 month, the landlord may lose a full month of rent while still paying the mortgage, taxes, insurance, and utilities. Vacancy can happen between tenants, during repairs, or when the rent is priced too high. A good rental plan includes empty months instead of pretending the property will always be occupied. Landlords also make money through appreciation when the property value increases over time. A home bought for $300,000 and later sold for $400,000 has gained value before selling costs and taxes. Appreciation can come from neighborhood growth, limited supply, better transport links, renovations, or general price inflation. It is powerful, but not guaranteed. Equity is where rent and ownership meet. If tenants pay rent and part of that money helps reduce the mortgage, the landlord's ownership stake grows. The tenant is paying for housing, not donating equity, but the owner benefits because the property debt is shrinking. This is one reason rentals can build wealth slowly even without huge monthly cash flow. Cash flow is the amount left after regular income and regular expenses. If rent is $2,000 and monthly costs are $1,800, cash flow is $200 before unusual repairs. If costs are $2,200, the landlord has negative cash flow and must cover the gap from other money. Positive cash flow gives breathing room. Negative cash flow depends on future appreciation or other income. Some landlords earn extra income through parking, storage, laundry, pet fees, furnished rentals, late fees where legal, or separate utility billing. These can improve returns, but they also require clear rules and fair treatment. Extra charges can create disputes if tenants feel surprised. Good rental income is not just more charges, it is transparent pricing matched to real services. A landlord's profit also depends on buying price. If the property is purchased too expensively, even good rent may not create a strong return. Investors often compare rent to purchase price, local expenses, financing terms, and repair risk. Two identical rents can produce very different profits if one property was bought at a fair price and another was bought during a bidding frenzy. Repairs separate serious landlords from wishful ones. A rent check may feel like income, but part of it should be reserved for future maintenance. Paint, flooring, appliances, plumbing, electrical work, roof replacement, and safety updates all cost money. A landlord who spends every rent dollar may be shocked when a major repair arrives. Property management changes the math too. A landlord can manage personally, answering calls, screening tenants, collecting rent, coordinating repairs, and handling disputes. Or the landlord can pay a manager, often a percentage of rent. Self-management saves fees but costs time. Professional management costs money but may reduce stress and mistakes, especially for distant owners. Tenant quality affects profit more than many beginners expect. A reliable tenant who pays on time and reports issues early can protect the property. A poorly screened tenant may create unpaid rent, damage, legal costs, or months of delay. Screening is not about judging people unfairly. It is about verifying income, rental history, identity, and the ability to follow the lease. Leverage can increase returns and risk. If a landlord buys with borrowed money, a smaller down payment controls a larger asset. If values rise and rent covers costs, leverage can work well. If rent falls, interest rises, repairs hit, or property value drops, the debt remains. Borrowed money magnifies outcomes in both directions. Taxes can also affect landlord profit. Rental income may be taxable, but owners may be able to deduct certain expenses depending on local rules. Depreciation, interest, repairs, insurance, and management fees may matter in some systems. Because tax rules vary by country and situation, landlords usually need proper records and professional advice rather than guessing at year-end. Selling the property is another way landlords make or lose money. The final return depends on sale price, remaining mortgage, selling costs, taxes, and years of cash flow. A property that barely paid monthly bills may still be profitable after appreciation. Another property with good rent may disappoint if repair costs and selling costs eat the gain. A realistic landlord looks at the whole picture: rent, expenses, vacancy, financing, repairs, tenant risk, appreciation, taxes, and time. Focusing only on monthly rent is like judging a business by revenue while ignoring payroll and inventory. The real question is not how much rent comes in. It is how much durable value remains after the property is properly operated. Rent increases are another source of potential income, but they are limited by market conditions, lease rules, tenant affordability, and law. A landlord may want higher rent, but a reliable tenant leaving can create vacancy and turnover costs. Sometimes a smaller increase with a stable tenant is better than chasing the highest possible rent and losing months of income. Turnover has hidden costs. When a tenant leaves, the landlord may pay for cleaning, painting, advertising, repairs, and time spent showing the unit. Even if the next tenant pays slightly more, those costs can reduce the benefit. Experienced landlords measure profit across the year, not only by the rent number on the next lease. Financing terms can decide whether the same property works or fails. A lower interest rate may create positive cash flow. A higher rate can erase it. A longer loan term can reduce monthly pressure but increase total interest. Landlords make money from property, but the loan structure controls how much room the investment has to breathe. Landlords make money when the property is bought wisely, priced realistically, maintained responsibly, and managed with clear agreements. Rent is only the visible part. The deeper profit comes from disciplined cash flow, protected equity, controlled risk, and long-term value. A rental property can be an investment, but only when the numbers and responsibilities are treated like a real business.